Again, guaranteed UL versus protection IUL. I've got two examples here. We've got two fine companies that we work with that have both of these products and are actually really good. So, first things first, in case you don't know, who is Advisors Resource Company? Our company was founded by a former chief actuary, and we have over 100 years of combined home office, regional office, agent experience. And our core values are growth oriented, get it done attitude, open and honest, adaptable change, and respect. So that's a little bit about us. That was a little brief, but you know what? We'll be following up after this meeting to talk to anybody who wants to about that. Um, we have a very unique process we call the Premier Producer process, and really consists of six things that we do for the agents that we work with. So we have tailored yet simple client presentations. We do case design and consultation. We have a process where we'll take the application for you. We have underwriting support. We have in-force policy management. And I moved the first one to the last, but that's top compensation and competitive products. So without further ado, that's my brief introduction. Um, a few people are joining in is what it looks like, but while they're joining in, again, my name is Jordan Pence. I'm a certified financial planner, and our company is Advisors Resource Company, and we help agents and advisors grow their life insurance business. So, GUL versus protection IUL. Um, IULs in the market sometime can get a bad name or can be ragged on because of the non-guaranteed elements. And I think that might be a mistake. And you'll see here in a little bit, there's new products coming out every day that have secondary guarantees on them that can make those policies last even longer on a guaranteed basis. But first off, let's talk about what is a guaranteed UL. So hopefully most people on this call are familiar with a guaranteed UL, but as the name implies, the advantages of guaranteed UL is it's guaranteed. As long as you pay the premiums, those policies are going to definitely contractually stay in force. The beauty of this is it can be sort of a set it and forget it. As long as you pay the premiums, and you pay them on time, really nothing is going to change. That's number one, easy for the client, but really after this is sold, as long as your client doesn't do anything different than what was originally planned, there's really nothing that's going to change. And while I think you should do policy reviews with your clients every year, and in fact, that's one of our value propositions is we help keep track of in-force policies. Nothing's going to change with this type of policy. So again, sort of set it and forget it. As long as you pay the premiums, it's not going to change. Now, I put in question mark two things: return of premium rider and accelerated benefit riders, question mark. Now, not all companies have these riders, but some of the top companies that we represent have them, and we promote those. So, as the name suggests, the policy itself is guaranteed to stay in force as long as you pay the premiums, essentially. So moving on from there, what's the disadvantages of a guaranteed UL? The disadvantages of a guaranteed UL, and I guess let me go back here. I got a question. What is guaranteed on the guaranteed UL? Well, it is guaranteed to stay in force based on premium projections, not the cash value in the cash value account. So most ULs, in order to stay in force, it has to have cash to pay the cost of insurance. So what the insurance company does is they have, like, for lack of a better word, a shadow account in the background that sort of has calculated out what they need as far as premium to keep the policy in force on the guaranteed basis. So it's a guaranteed death benefit as long as the premiums are paid. So disadvantages. Number one, little to no cash value. Um, Little to no cash value. That's the disadvantage. Surrender values can be quite low, and there's no cash buildup or surrender value potential later on, or if it is, it's very little. The premiums generally, without uh, generally shouldn't be skipped, or the premiums are required based on the original plan. There's a little bit of flexibility here, but not a ton. And generally, if you miss some premium payments, it's going to be quite substantial to make up for it. Secondarily, lacks flexibility. There's no real flexibility in if it overperformed, do you get to pay less and so forth. And then finally, typically, as compared to non-guaranteed products, has a higher premium. Now, if you compare it to whole life, it has a much lower premium per the death benefit, but generally compared to protection IULs and the like, it's going to have higher premiums as compared to those. Protection IULs. Now, when I say protection IULs, the reason why I'm saying this is as opposed to IULs that are designed for cash value accumulation. So there are IULs that are designed more for cash buildup. There's also IULs designed more for lower premiums um, for the death benefit, or to pay for the death benefit. So typically you'll see these have a lower premium, lower than whole life, lower than a GUL. Another advantage is you generally have cash value in any given year. They do have flexibility in that if the contract overperforms, you may not have to put as much into it, or you may be able to skip a couple of years. You may be able to make up for that premium. So there's a lot of benefits there. And then again, some of the companies that we're working with, they have return of premium riders guaranteed. They also have accelerated benefit riders that can be potentially built into this. And if you're not familiar with accelerated benefit riders, that's something maybe we should talk about in the future, but accelerated benefit riders are generally critical and chronic illness riders where you can accelerate the death benefit while you're still living, meaning you can get the death benefit while you're still alive. So pretty straightforward. What are the downsides? Well, generally, protection IULs have limited guarantees in that it might not be guaranteed if you pay the premiums out to age 121. We might be relying on some index performance and so forth. So you might not have the same guarantees. And really, you should be reviewing this at least periodically to make sure the performance is up to par with what was originally projected. Benefit to this is if it's overperforming, you could actually maybe reduce your premiums a little bit. Or make different changes or make a withdrawal or something like that. So there's some benefits to that, but there's also some disadvantages. If it's underperformed, you might want to make a little bit more of a premium payment. So, part of the reason UL in general gets a bad name from the media is back years ago, there was a lot of UL sold with very high interest rates initially. Market rates were at, whatever, 12% or even 20%. And those ULs carried the same interest rate. Well, obviously, with a higher interest rate, you need less premium to carry a policy with a higher interest rate. And so those ULs that were sold back when interest rates were high ended up lapsing because, well, they were underperforming. No one was reviewing them. So that is a disadvantage of this, is you've got to review them. You got to at least stay on top of them. So how do they stack up? How do they compare? What's the premiums? Blah, blah, blah. So you could look at a lot of different scenarios, but I like showing short pays, and generally maybe a 60-year-old might be appropriate for this. You could do as young as you could do 20-year-old if you wanted to on this and just have permanent life insurance. Premiums would be a lot less, but it's one of those things. So over that 10 years, the premiums on the guaranteed UL is 416,000. So you put in 416,000, you're guaranteed $1 million death benefit. And you have this cash out rider. Now, in year 10 with this product, well, this is actually more on this in a minute. So this is actually year 15. You have this 271,000 as a cash out. Year 20, you have the 416, and then year 25, you have the 416 and payout. But anyways, this is on $1 million death benefit. And if you look over here on the right-hand side, you have the cash values on this protection IUL, and then the total premiums. The total premiums are less, 35,000 a year versus 41,000 a year. So you can kind of see the benefits there. Now, I want to go on to the GUL ledger. And as you can see, 41,695 for 10 years is the premium. That's guaranteed out to age 121. So this guarantee continues out. And I've just highlighted those years. You can see like year 90, there's no surrender value. Year 17, no surrender value. It's one of the disadvantages of this, but guaranteed paid up no matter what happens, guaranteed. And this goes all the way out to 121. I didn't quite include that on here. And then I have a protection IUL. Again, this protection IUL has some secondary guarantees. So if you look on that sort of purplish, bluish first three columns, you can see the guaranteed column. And actually, this product happens to be guaranteed out to age 86. So if you made those premium payments, no matter what happened, you'd have $1 million of coverage till age 86. The second column is an interest rate somewhat lower than the projected rate, which is 3.75. And so if you only got 3.75, the coverage, and you put in those premiums, the coverage would last till 92. And then the far right-hand side is if you performed at, it's somewhere between 5 and 6% year in and year out. This is what you would have, and the policy would last till maturity and so forth. So that's the main differences between those two. And, that's how these work. I got a question. Are there a lot of 60-year-olds that can pay 35 or 40,000 a year over 10 years? Yeah. I mean, there's many people out there that can pay that type of premium. And this is for $1 million of death benefit. I mean, it's actually quite a good value if you think about it. You're putting out 350,000 to get $1 million. It's actually a pretty good internal rate of return, and you have to remember the death benefit is not taxable. So that's another huge benefit. And in this protection IUL, you at least have the surrender value if you ever wanted to cancel it. So yeah, I'd say, yeah, we see it. I mean, this specific scenario isn't probably a extremely common one just because of the narrow age, but at various age levels, we see plenty of people putting in that type of premium. And the coolest thing about this is take a look at the surrender value. The surrender value after 15 years is equivalent, if not higher than what you put in. So if you decided you didn't want it, you had that coverage for no cost over that 10-year period. So some pretty strong benefits there. So I'll leave it at that with my contact information. If you have any questions, I'll be happy to answer them now, or you can shoot me an email. There's my contact information. Brendan's contact information is also in there. Brendan is going to be reaching out to everybody. So if anybody has any questions, he'd be happy to answer those as well. But I'll stick around for a couple minutes and answer whatever questions there are. And thanks to everybody for joining. I hope you found this, and I'm exactly on 15 minutes, so I hope you found this topic interesting. and useful, and hopefully you can get something out of it. And if you need any quotes or anything like that, again, feel free to reach out. Happy to to help and go from there. Thank you.